I invested $50 million in Apple and Amazon 9 years ago. I made $500 million off of it. It's a 10 bagger. Not that hard. I'm not proud of it. All I did was buy these digital networks when 99% of the people didn't agree with me, when they were unstoppable, and I waited. And I swore to myself, if I ever saw another one, I wouldn't just do it personally. I would put my company into it.
Many know Michael Saylor because of his infamous decision to turn his multi-billion-dollar company's balance sheet entirely into Bitcoin. However, Saylor is not given enough credit for his savvy investment moves that originally made Saylor a billionaire. Saylor was an early investor into Apple, Amazon, Facebook, and Google long before it was a clear decision that these would be leading tech companies. In his latest interview, Michael Saylor explains why Bitcoin is an even larger opportunity than the tech giants over the early 2000s and why investors are going to sell off every other asset for Bitcoin in due time. Make sure to stick around to the end of the video where I will cover the latest on-chain Bitcoin data to see if it backs up Saylor's thesis. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and can always change your mind.
I think the people that lived the last decade, the first decade of Bitcoin, have been scarred by their experiences because they had a very volatile first decade. But I think that those are misleading because the system has evolved. Institutions have come into the marketplace. And since March of 2020, it's a totally different asset class. If you look at the chart since March, it goes up 50%, down 25%, up 50, retraces 20, up 60, retraces 25, 30, up 50, retraces 25. And so it's actually simply growing from 4,000 to 60,000. The way I explain it to people is if you studied LeBron James's career from age 9 to 18, he was talented but volatile. But it would be a mistake to extrapolate from the first 9 years or first 10 years to the next 10 years. From age 18 to age 28, LeBron James was the greatest athlete in the sport and not volatile at all. Not volatile, except in a good way. If you're staring at a basketball court watching stuff move, he's actually making everything happen. He's the volatile game maker that's destroying everybody. But it's not a bad volatility. The bad volatility, you want to get rid of volatility, put a lump of rocks on the basketball court, you have no volatility. So I'm not terribly concerned with the volatility. I think there'll be accelerations and pullbacks, but the institutions are collaring it on both sides. The capital is not consumer leverage capital, day traders. The capital right now is insurance companies, big public companies. We're coming in to buy it forever. We're not ask me when I'm going to sell it. Never. I'm not going to sell it ever. And so the narrative has rotated. Long-term institutional deep pockets, and the asset class has matured. And of course, the law of large numbers say a $1 trillion entity has more inertia to it than a $100 billion entity. And what do I expect to happen? I expect it will grow aggressively toward gold, and it will flip gold, and then it will demonetize gold and subsume gold. And probably it'll be first $10 trillion and gold is 10 trillion. Then it'll be 20 trillion and gold will be 5 trillion or 4. And gold will eventually become an ornamental metal. Bitcoin is going to suck the monetary energy off of negative yielding bonds. Tom, I ran a survey on my Twitter. I got 65,000 responses 2 days ago. I asked people, where did the money come from you used to buy Bitcoin? 49% is stocks, 20% is gold, 10% is bonds, 19% is property. Basically, stocks are going to be negative yielding if you're value stocks because they can't keep up with the rate of monetary expansion. Everybody knows bonds are destroyed. Ray Dalio just told the world they're all negative yielding. By the way, he thinks they're negative yielding versus CPI. The real point is they're negative yielding versus the cost of capital or the rate of the monetary supply expansion, which is like 15 to 25% a year. They're screaming value destroyers. So I think that Bitcoin goes to 10 trillion and it goes as fast as it can. And then it grows 50, 60% a year toward 100 trillion. And it slows down from 200 to 150 to 100 to 80 to 60 to 40. You saw Google and Amazon growing at 20% a year off of large numbers consistently for the past 5 years. I think when it gets that big, it'll be growing 20% a year. And eventually it'll subsume the total addressable market for treasury assets. And then it will be growing at an organic rate, 5, 6, 7%, a fair cost of capital. I think the single most important thing you can do is estimate the annual rate of money supply expansion every year for the next 8 years. And if you think if that's 15% going to 10, going to 5, going to 2, going to 0, then you're going to stick toward a traditional portfolio. But if you think that money supply expansion is going to be 15% consistent, then you got to go to scarce assets. Bottom line is, I don't think bonds or real estate work as a store of value in a monetary inflation environment, because they're both, one of them's a coupon and the other one's pegged to CPI or capped at CPI. I think that that value stocks are, you've basically got to invest in an index of equities that are going to grow, or you got to invest in scarce assets. And if the growth rate of the money supply is 15%, you better find a portfolio of equity that's going to grow 15% or better if you're going to store value in it. Otherwise, I would invest in trophy assets. Buy your house on the beach that you want to live in the rest of your life, because that'll always be valuable to you with leverage. I think you buy scarce digital, probably like Bitcoin. You buy things that are buy something that a rich person is going to want to buy from you in a decade. Ask yourself that question. I'm not buying your New York municipal bonds yielding 2% in a decade, right? And you're going to get a negative 15% real yield. So I would think in terms of that, trophies, equities, and then scarce assets. And obviously I'm biased. I think Bitcoin is the best property in the world. Figure out what your risk tolerance is for it, buy that much of it, and then diversify the rest across other things you know and you're comfortable with. Bitcoin is the world's best treasury asset. It's like 100x bigger than the next thing. The risk is 1,000 times less than the next thing. The addressable market is 100 times bigger than it is right now. It's its own thing. Everything else in the crypto universe is venture capital. If you have a venture capital portfolio, if you have the wherewithal to invest in crypto ventures and you want to study it, well, in my opinion, they have 100x less addressable market and they're 100 times more complicated. But if you want to do that and you have the capital to do it, have at it. If what you want to do is just buy a bar of digital gold and wait, I mean, Bitcoin is better gold than gold on a big tech network, right? It's just, you just buy a bunch and you wait. We're not crazy. The point is, it's the world's first digital treasury asset. There's $100 trillion worth of treasury assets that are negative yielding debt or zero yielding debt or cash. And that's like, in essence, minus 15% real yield. All the bonds are broken. All the treasury strategies are broken. This is the solution to $400 trillion worth of investors' problems. They've all got the problem. It's the solution to 7.8 billion people's problem. They're all generating salaries in cash, which is debasing at 15% a year. And it's the most disruptive technology in our lifetime. And, I've been on your show. You had me talking to you about 8 years ago. We're talking about Apple and Amazon. If you recall, you could probably pull the clip. I invested $50 million in Apple and Amazon 9 years ago. I made $500 million off of it. It's a 10-bagger. Not that hard. I'm not proud of it. All I did was buy these digital networks when 99% of the people didn't agree with me, when they were unstoppable, and I waited. And I swore to myself, if I ever saw another one, I wouldn't just do it personally. I would put my company into it. So we ran into the biggest crisis of our career in 2020. I had $500 million in capital. I saw a digital network, which I think is 100 times better than Google or Facebook. It's Facebook for money. When Rupert Murdoch goes to Facebook, he doesn't bring 1 billion friends. He's not paying $100 million a month to watch Netflix. Okay? When a billionaire shows up to Bitcoin, they buy $1 billion of Bitcoin. It's a bank in cyberspace. It's self-monetizing. And so I saw that. We bought some. It's working. There's an institutional rotation. All the institutions have the problem. They're all buying it. That's why it's gone from $4,000 a coin to $60,000 a coin in 12 months. And quite frankly, I think it's the biggest thing of our lifetime.
So there's Michael Saylor on why he thinks Bitcoin is one of, if not the investment opportunity of our lifetime. To check out some recent on-chain Bitcoin data to see if it backs up Saylor's thesis, out from on-chain analyst Will Clement, a graph for long-term Bitcoin holders, if you judge the value of a network by its user growth like you would Facebook or Google, as you can see, Bitcoin user growth is strictly up and to the right. We also only have 10 years of data on this, as Bitcoin has only been around that long. Just imagine what the next 10 years is going to look like. Anyway guys, hope that provided you with some value. I'll see you all in the next video, and as always, have a great day.